And tonight we're going to talk about how to take an old 401k plan and turn it into your very own bank. Okay, and the stats on this are pretty cool. So about 66% of Americans have some form of retirement plan. Okay, that could be a 401k, an IRA, a 403b, whatever that might be. Every 5 years, the average American leaves their job. So what that means is every 5 years, most people have a chunk of money that they're going to put either with a financial advisor and give to Wall Street, or they're going to roll it into their new employer's plan and also give it to Wall Street. And we've gone over before on our course that Wall Street's kind of a terrible place to invest money. Just as far as fees are concerned, volatility, you aren't actually getting anything. It's essentially a bunch of IOUs till you turn 60. So it's not a great place to invest. And so we look at when a client has money that they've put into a 401k, it's accessible. How do we take that money, unlock it for them, okay, give them access back, salvage it, and help them turn that into their own banking system? Okay, and when I say banking system, what I'm referring to here is I'm referring to a way where you take a central location of money and you basically route all of your money through that location. Okay, and if you know anything about banks, the way banks operate, they don't just take deposits and hold your money for you. They lend your money out, they invest your money, and they earn what's called a spread, which is the difference between what they pay you on your money and what they can earn on your money. And so when we think about turning your 401k into a bank, we're also thinking about the spread. Okay, how do we take your money that you're earning on and loan it out to your own bank, to yourself, and earn even more money on top of that money so you have that spread? And so that's what we're covering tonight. So I'm going to dive into this. And the first thing that we're going to discuss is what types of accounts are eligible. So the first thing is it has to be qualified. So you can't do this with just any lump sum of money, any plan out there. There's certain plans you can do it with. So you need a qualified plan. So that could be a 401k, that could be a 403b, that could be a TSP. It has to be a qualified retirement plan. All right, you can also do this with traditional IRAs. So if you've got a native traditional IRA, meaning that it came from your own personal income, you can roll that into a qualified plan like we're talking about tonight. It's going to be a self-directed retirement plan, and you can utilize those funds instead. Okay. Now, ironically, and we also talked about this a few weeks ago, the only plan that you can't do this with is the Roth IRA. Okay, and I could never figure this one out. I just thought of this one this year and realized why you can't do a Roth IRA. So a 401k is protected against nationalization, and it can't be recharacterized or changed by the federal government. And so basically what you got to look at is, with your 401k, can you mute that? So with your 401k, if you rolled a Roth IRA into it, that Roth IRA is now protected. If you don't roll the Roth IRA into it, the government could reclassify the Roth to a traditional. They could nationalize the account. And there's ways that they can manipulate that money. So if you think about it, if you put that into a 401k, they've now lost that ability. The IRS cannot get their hands on a Roth IRA. So that's my opinion on why you cannot put a Roth IRA into a self-directed 401k. The government doesn't want to lose their ability to tax that money if they need to. As soon as it goes in the 401k, they can't do that. But if it's in a Roth, they still can. So you can't do it with the Roth IRA. The funds have to be eligible for a direct transfer rollover, meaning you've got to have, it's in one plan and it's eligible to move to the next one. So that means that it's probably not funds that are in an active 401k where you're working. It needs to be something you can actually move. If it's a simple IRA, it does need to be outside the 2-year window. Okay, so that's qualified. If it's not qualified, you can't do the deal with the 401k. Now, the next thing is actually establishing the plan itself. So the first thing you have is you actually have to set up what's called a qualified plan trust. Okay, a qualified plan trust. Many people don't know this. A 401k is really just a trust. So people think I have a 401k account and they think of like this tangible place they put their money. 401k is actually just an internal revenue code. It's not actually an account. It's a tax classification. And the classification is basically adopted to a trust. Okay, and that trust doesn't hold money in itself. The trust has some sort of an account. It could be a business trust checking account or a custodial account where you actually put those funds. So you've got to have a qualified plan trust. This is a legal document that's written with its own adoption agreement, its own laws, its own characteristics on how the fund can be, or how the account can be invested. And so that's something you have to have done correctly and professionally. It's not something you can go on LegalZoom and try and get done yourself. You actually do need to make sure it's done correctly. Now, once you've gotten the qualified plan trust established, you've also done the adoption agreement for the 401k itself. So you actually have to do an adoption agreement where you're taking the plan and adopting it as a 401k. And then you've got to send that into the IRS for approval. So when you think about like everything that goes behind having a 401k, most people are not used to these terms, because when you do your 401k at work, you just auto enroll and all of this gets done for you. But realize, as soon as you decide to take your 401k and turn it into a bank, you're stepping into the world where you're self-directing your account, meaning you are the custodian. You are the trustee. You're the one that does all this stuff now. And most of us don't know how to. So that's where we come in. We'll help our clients put this together so that they can do this and have some professional help. Now, once you've gotten the IRS approval, you've got to do stuff like get your EIN number. You do need a holding account. You've got to have proper transfer instructions. All of that's got to be set up correctly. And the reason why is this is high stakes. So if let's say I had my 401k account, I'm going to roll it over. If I have the wrong adoption agreement set up, I might roll my plan over, but if the adoption agreement didn't classify it as a 401k, I now have a taxable event and I've got to pay a 10% penalty. Or let's say that I did the adoption agreement, but the IRS didn't give me approval. I might have a great adoption agreement, but again, the IRS didn't get the message. I roll the account over. All of a sudden, next year at taxes, I've got distribution forms and I have a taxable event with a penalty as well. Or there's a bunch of ors on this, guys. Or I do it and I don't get the EIN number set up. So I get the IRS's approval. I have the plan adoption agreement, but I didn't get the EIN. And so because of that, when my investments pay me, they send it to my personal social security number instead of the plan's EIN number. And again, I have a taxable event with a 10% penalty. The last one, you could set all of that up perfectly. And if you set up the wrong type of bank account, it looks like you're commingling your funds with your 401k funds with your personal funds. And again, you have a taxable event with a 10% penalty. So you have to do all of this stuff like very particularly, just like any legal transaction. Okay, if I'm doing a mortgage with Jeremy, there's a certain way we do the mortgage. We can't just grab whatever forms, throw it all together and do whatever and borrow money from a bank. Okay, so you have to do everything within the lines here. And so here's the thing, because of how this plan is set up, it's not often used by most people. Okay, I've had financial advisors that have been in the business for decades sit down and try and fight me and tell me the plan doesn't exist, that it's not a real thing because they've never heard of it. Okay, Lexi was on a call with Edward Jones last week. And the guy literally was like, well, I think I would know about this. I've been in the industry 17 years. There's not much I haven't seen. And what you're doing is not correct. It's not a real plan. You have to have a custodian. They don't understand anything about the plan. We've had CPAs call us. They don't know what it is. So the fact is it's a real thing. Most people don't know what it is. Most people don't know how to use it. And so because of that, you have to have a professional in your corner setting it up to relay this information and make sure it gets done right. Because it could even be like you did it all right, but because the losing company didn't know what it was, they sent you the wrong stuff. Now you have an issue on your hands and it was their fault because they don't know what it is. So you have to really clarify like how you're setting the plan up, that it's a self-directed account, it's a qualified plan trust. All of that stuff has to happen in order for this thing to get set up correctly. Now, once you've established the account, what you're effectively going to have is you're going to have a big, thick pack of paper. You're going to have an LLC trust checking account with some kind of bank that's going to sponsor the account for you. And, at that point, you have somewhere to send the money. And at this point, we call this next stage whipping the mule. Okay, whipping the mule. So I want you to realize we are dealing with Wall Street. So you're going to do what's called a direct transfer rollover in order to get the money from A to B. And think about this. There's one company now that currently has your funds. If you've seen any of our courses on Wall Street and mutual funds, you know that they make a lot of money by holding your funds. So think about this. You are just an individual with 70 or 100K in your account. They know you don't have a legal team. They know that you don't know how this stuff works. And you gave them your money, and now you're asking for that money back from a multi-billion-dollar organization that has a legal team and salespeople and administrative services and all this stuff. This is literally David versus Goliath. And you're going to go ask them to give you $100,000 of your money back. And legally, they do have to. But here's the thing. They can take as long as they want. They can have as many issues as they want to have. They can lose your paperwork as many times as they want to. And so it's, at the end of the day, a billion-dollar company doesn't want to lose money. They have a stack of applications and phone calls for incoming funds that are going to pay them, and they have a stack of applications for outgoing funds that they're going to lose money on. No different than when you have bills. If you had a paycheck to cash or a bill to pay, most of us are going to cash the paycheck. Doesn't mean we're not going to pay the bills. We're just going to wait till the last minute and pay them at that point when we have to. But if we don't have to pay them, most people don't like to pay them. It's behavior. And so the custodian that's losing the funds does the same exact thing. So when you order the rollover, here's what's going to happen. You're going to call them and they're going to tell you that you have to supply them with a form. You don't have the form because they have the form. But they're going to tell you you need to produce the form, but you can't produce the form because it's their form. Then you're finally going to produce the transfer form and send it to them, and they're going to say, oh, we only accept our own forms. You can't send us this. We have to give you ours. We'll fax it to you. We'll email it to you. So they'll finally send you their form. You won't know what it means. You're going to have to fill it all out, send it back to them. You'll do it wrong. They won't tell you you did it wrong. They just won't call you back for 3 weeks. When you finally call and say, hey, how about that form? They're going to say, oh, yeah, you filled it out wrong. You've got to do it again. And you'll do this as many times as it takes for you to actually get the form done right before they finally accept it. And guess what? They won't tell you they accepted it. You've got to call and say, hey, did you accept the form? Legally, they're not doing anything wrong. They're just not doing anything right. Like, this is actual stuff that happens when you try and move money. So this is called account preservation. The losing company is trying to preserve the business because when you say, I'm going to turn my 401k into a bank, I'm going to start self-directing, that means they lose fees. Every day they hold your account, they get more fees. So I've had a client where it took us 8 months to roll her money over. 8 months. Think about that. When you call and ask for a transfer from one bank account to another bank account at your banking institution, imagine if it took 8 months. And there was all these forms you had to fill out, and all of this stuff was this big, long, drawn-out process. But guess what? When you gave them the money, it only took 30 minutes. They did that super quick. As soon as you wanted the money out, though, now it's an 8-month process. So this is called account preservation. They know that every day that they keep your money longer, they can earn more in fees. It's profitable for them. Yes, they know they're going to lose your account. So they're going to prolong it until they don't have until they very last minute, so they don't have to lose out on the fees. And meanwhile, they know that you're just going to run around like a chicken with your head cut off, trying to figure out how to do this. So, and I can remember before I knew all this stuff, like as a brand new financial advisor, when I started my first couple of rollovers, I thought it would be easy. I was like, yeah, we just fill out the forms. They send the money. It's cordial. It's business-like. So I had a lady that early on in my career, she was like 70. I literally had to write a script for her to call her custodian and yell at them to get them to move the money over. And it wasn't until I had her say she would take legal action that they actually did it. Okay, this is why we call it whipping the mule. These companies, guys, they're not on your side. They're not looking out for you. They're not trying to help you. They're trying to earn fees and not go to jail. That's their main job. If you make money, cool. But when you try and get your money back, that's how much you see how they really do care about you. They don't. They just want your funds in the account, earning fees away from you. All right. Now, the other one I can talk about is, I think this was with TSP. We had somebody that had a TSP account. And there was like this weird window of like, it was an administrative thing. They said, if you don't mail the form by this date, then we're not going to count it. And you've got to wait for the next month because we only look at the forms from this date to this date. So imagine like, I mailed them the form and they're like, oh yeah, well, we got it on the 1st, which means we didn't check the mail that day because we only checked the mail on the 5th. And if we checked the mail on the 5th, we're only going to look at these till the 7th. So if you missed the window, now you have to wait till February. And if you miss the window again, now you got to wait till March. Like they'll just keep doing that over and over and over until you finally just, quit. That's what they're trying to get you to do. They're trying to get you to give up on transferring the funds. They don't want you to become your own bank. They like being the bank. They like earning money on your money. So they're going to try and get you to give up. They'll wear you down. And then finally, you'll do the same thing you did when you signed up. I'm confused. I'm worn out. I'm tired. I don't understand this. I'll just leave it here. Just like when you signed up, I'm confused. I don't understand this. This meeting's really long. You're the professional. Just take it. That's how Wall Street does business. So the losing company is going to use those preservation tactics. The other thing is the losing company is extremely uneducated on this particular strategy. You will talk to the most confident financial advisor or account management rep that thinks they know everything in the world, and they will tell you to your voice, I guess, on the phone that you're wrong and that they can't do what you're asking because what you're asking them to do does not exist. They will confidently tell you that. And you'll feel wrong. You'll be like, man, maybe this isn't a real thing. Like for a moment, you'll be like, I know I set the thing up and I've got the adoption agreement and I know it's a real thing, but maybe it's not. They're telling me that it's not a real thing and they've done this longer than I have. They're confidently uneducated. Okay, nobody is more confident than an ignorant person. An ignorant person thinks they know everything. They don't know anything. They don't know what they don't know. Therefore, they come across like they're right. And they don't think that they're wrong because they never explored the possibility outside of what they do day to day. So they're going to feel like they're right. And ultimately, like if you do this correctly working with us, this is how we help our clients. When we do this deal, we call them every 48 hours. Every 2 days, they're going to get a phone call from Wealth Dynamics. Hey, Dingus, did you do the account yet? No? Remember we sent that form? You need good. We photocopied it. We'll send you another one. Do you need it still? Perfect. And we know exactly how to ride this thing. And if you do it correctly, like from A to B, it's probably a 2 to 6 week process. That's if you do it correctly. If you do it incorrectly, it could take, like I said, 7 months if you don't know how to get the money there. And this is a killer because in like this space, if you're doing a self-directed account, you're probably doing real estate, you're probably doing private lending, you're probably buying bullion, you're doing time-sensitive stuff. So imagine like you thinking you're going to transfer your account, signing a letter of intent, and then the money taking 7 months. And you losing out on the deal and the deal falling through because 7 months ago you signed up to do this thing and it hasn't happened yet. So you have to really lock this thing down. If you don't have a professional on your side, you will get worn down. You will quit. That's exactly what they want you to do. All right. Now let's say the funds actually get moved over. Now they're here. They're in the account. What do we do next? So like I said, a 401k is not an investment. Most people don't know that. It's just, like I said, a tax classification owned by a trust with a checking account in it. It's not an investment. Meaning when you put the funds in the new 401k or in the new plan, they're not growing. It's literally just going to be in a business trust checking account. It's just going to sit there. It won't grow. You won't see anything happen. So once you've got the funds moved over, you still have to invest those funds. You've got to put them somewhere so it actually grows. And so here's how we do it. This is how you set up the banking system in the 401k. We've moved it into the self-directed 401k. It's ready to roll. It's just in cash right now. We're going to take 49% of the funds and we're going to place them in what we call a modified endowment contract. Okay, a modified endowment contract, also known as a MEC. Now, don't get confused on the terminology. This is just life insurance jargon. So this is high early cash value, dividend paying whole life insurance. Now, life insurance policies have a limit called the MEC limit. So back in the 80s, wealthy people used to put tons of money in life insurance. There was no limit. So the IRS came out with the MEC limit. Mike, wake up. So the IRS came up with the MEC limit and said, hey, if you put past this amount, we're going to tax you. And so basically, if you go past that amount in a policy now, you get taxed. So you want to avoid the MEC limit, typically. But I want you to think about this. If you overfund a life insurance policy, what that does, if you cross that MEC limit, like taxes and stuff aside, is it gives you very, very high liquidity on the money. Very high liquidity. And I'm talking like we've had clients that had in the first year, like 97% of the funds they put in, they can pull out right away, which is unheard of with life insurance. Like most agents write you a policy, you have zero the first year. Even like best case scenario, you've got like 75 to 95%. So if we MEC it, we can get like 97 to 99% of the money available right away, which means we have all of our purchasing power to go invest with because we MEC'd the policy. Now you're probably thinking, well, Jerry, you just said it's taxed. It is, but it's in a 401k. What does a 401k mean? It's tax sheltered. You're deferring the taxes. So you can MEC a policy in a 401k. The IRS can't tax it anyways because the 401k is tax deferred, so they can't touch the MEC. This is the beauty in the strategy. So you're setting the MEC up, you're overfunding it. It's called a single premium. So most of the time you're going to do, like if you had 100K, you can do 49% of your overall 401k balance in life insurance. So you're going to put $49,000 into a MEC. Not 50, not 51. You'd be breaking the Internal Revenue Code if you did that. So 49% is the most you can do. It's called a single premium contract. You just drop it right in. Most of it's cash value. You do have a death benefit. And what happens is you're earning a 6 to 8% gross annual dividend on this money, which is inside the 401k. And what you're going to do is you're going to take that money and you're going to pull it from the MEC, still in the 401k, and we're going to go invest with it and earn double interest rates. Okay, so a couple things you need to know. You did just put life insurance in a 401k. Typically, life insurance is tax-free. Because it's in a 401k, it's obviously going to be now tax deferred, meaning it's money that, just like any 401k, when you finally do withdraw it, you will pay income taxes. A 401k is a 401k. A life insurance policy doesn't change that. So you're still abiding by the 401k rules. There's also something called economic benefit tax. And the easy way to kind of describe this, it's almost like property taxes. So if you own life insurance in a 401k, there's an algorithm the IRS uses that's going to dictate the difference between your death benefit and your cash value. They're going to find out how many units that would be. And there's an average cost per unit they'll assign. And then they'll do a calculation to find out what income tax you would pay based on that. And it's usually like a couple $100 a year in income that you'll be taxed on. So it might be $200 for the year in extra income, and you'll be taxed on that income because it's an economic benefit for you to have a death benefit in your life insurance. So that's how that works. Now, when you do pass away, the life insurance death benefit pays to your 401k. And basically that 401k can keep it sheltered. When the death benefit money, so let's say I pass away, death benefit money goes into the life insurance now, and my beneficiaries now have my 401k. If they start withdrawing money, they will pay income taxes, but they won't pay income tax on that money that was already taxed as an economic benefit. You can't tax money twice. Okay, so realize that that's one of the things you got to look for. And as you guys are listening to this particular part of our course, it's probably very confusing. And it kind of is if you don't know what you're doing, just like anything. And that's why you do need an agent to set this up for you. So it's not something you would go do yourself. You can't go to the eSurance website and go buy a MEC. Like, you have to have an agent that does that for you. So you want to have a professional guide you through this process. The good news is we do that for our clients. So you've got the MEC set up. All right. So you've got 49% in a MEC at this point, and then you got 51% that's not in a MEC. It's still just cash. What do we do from here, right? So here's the strategy. So that 49% from our MEC, we're going to immediately borrow that from the policy. Okay, so we have the policy here, and I'll illustrate this for you. So we've got the policy here inside of the 401k. So that's our big umbrella, is the 401k itself. And then let's say on this side, we have the MEC. We have 49% of our money here. And then on this side, we have just cash. And we have 51% of our money here. So that's kind of what this looks like. Now realize this is all still within the 401k. So we're going to take this MEC money. We're going to borrow it from here. So we've got a loan going on from the MEC, still inside the 401k. We're going to go invest in real estate. Okay. And we're going to go invest in a deal that's going to pay us 8 to 12% annual cash flow. Right? Now we are borrowing from the MEC. The cost to borrow from the MEC is 6%. Okay. Now the MEC is going to earn 6%. And what we're going to do here is the cash flow, and we're going to get to all of this to tie it back in a second. The cash flow from this 8 to 12, we're going to pay our loan off early with. And what that does is this 6% is daily simple interest. And it's due once a year. So what that means is if I pay my loan off early, I'm reducing my principal. Therefore, I'm reducing my interest due at the end of the year because it doesn't compound. So every day I pay off early, let's say I've got $365 in interest that I have to pay if I left the loan outstanding. Well, every day I pay that interest off early, I'm saving $1. which then gives me a positive arbitrage spread between what I'm earning and what I'm paying. So that's why we want to do a cash flowing deal. We wouldn't do this to borrow against it on an appreciation based deal, because it's not going to pay our loan back, and effectively we'll earn a net of 0 arbitrage on our MEC. Now, if we can get this down to where, you know, our gross interest, yeah, it's 6, but let's say we paid it off early and our net interest was only actually like 4. Okay, well, now we made a positive 2% spread on our dividend interest rate, plus we actually made an additional 8 to 12% on the deal we did, just by putting the policy in a MEC, or the money in a MEC policy first. So let's say I did make 12 and I had 6 here and I paid 4 here. I've got a 2% spread. I turned a 12% return into a 14% return just by positioning the money differently. Cool, right? Now, we've got this cash here as well. Okay, this is just cash inside the 401k. We're also going to take this cash and we're going to go invest this also in real estate. And that's going to also earn an 8 to 12% annual rate of return. And we're going to take the cash flow from this and we're going to double pay off our loan. So that's going to drive our principal down even faster, and it's going to help us pay even less in interest. So think about that. You're paying this entire deal off. You're earning 8 to 12% here, 8 to 12% here, and then you've got 6% gross being earned. After your interest rate, you're probably earning 2 to 3 in net interest on your dividend. And that's what's happening inside this deal. So really what this does is it helps you hyper grow the money. And the benefit here is this is all going to be guaranteed against loss. And this is all going to be real assets. Okay, these real estate deals, they're not REITs. It's not a piece of paper. You've actually got like a private lending deal or real estate deal. There's a real asset there. Okay, so if you lost money, you would still get to keep the asset. The life insurance can't lose money. It's guaranteed against loss. So you've got a very secure strategy, but it's also very lucrative from a return standpoint. And in stock market investing, there's what's called a standard deviation. A standard deviation is the concept of if you can earn 12 on average, that means that on average you could earn more than 12, but you could also lose more than 12. Right? So if 12 is the median, they're going to say, well, on average, 12 might be the median, but there's a possibility that you could get an upward swing of 16 or a downward swing of 16. So it's incorporating the risk involved. If you took a standard deviation here, there's no up or down. You're going to earn 12. There's not going to be a chance that you can get more than 12 or a chance that you can get less than 12. You will earn 12 because that's your rate of return. So you're getting rid of volatility with this, which really gives you a consistent return. And in your current 401k, like me and Mike joke about this all the time. Like people will be like, man, I made 13% last year. And what they're looking at is they're looking at the average annual return of the fund they're invested in, but their account didn't actually make 13%. Because the year before, it lost 13%. And in order to make all of their money back and actually earn a net positive gain of 13%, they would have had to make 26%. 13 to get the money back to where it was, and then 13 to actually make a positive 13% return. So you're eliminating that risk by doing this. There's no year where it would lose 12 and then you're up 12. It's just 12 every single year. Or if your number was 8, it's just 8 every single year. Okay, so you've got this strategy going on where you're returning the cash flow, and the net returns, if you do this right, should always be 10 to 15% combined. Okay, 10 to 15% combined. Now, nobody watching this can tell me that right now in their 401k, they're earning 10 to 15% every single year without any chance for loss, and that they're not paying annual management fees to Wall Street to do all this stuff, and that there's no chance they're going to lose the money. Okay? So that's what you've got to really look at. This is a consistent model. This is something that works year after year after year. It is the boring plan, which is always the best plan for creating wealth. Okay, so we talked about the other 51%. So we're going to do this, like I said, in another 8 to 12% deal, pay off the MEC early. And the benefit here, if you think about this, you've got one 401k, entire deal is tax sheltered. You have your cash growing at 8 to 12. You have your 401k MEC policy growing at 6. You've got your real estate growing at 8 to 12. And so what this is called a taxable equivalent. Meaning if you're bringing in, let's just do the math really quick. If you're bringing in, let's go low here. Let's say you're earning 8 here. You're earning 2 here. And then you're earning 8 here. Okay, that's 18% total. Okay, and if you divide that out, like you're probably averaging right around that 10 to 12. So let's say you're averaging 10. Okay, well, if you were averaging 10, and this is tax sheltered, meaning it's not being taxed as income. In order for you to make 10 outside of a 401k like this, if you were just investing regularly, let's say you're in a 20% tax bracket, you would actually need to be earning 12.5 in order to keep 10. So if you did all of this stuff and you were paying income tax on it, if your bracket was the let's say the 20% bracket, you would have to earn 12, you pay 20% in taxes to keep the 10. So the taxable equivalent of a 10% rate of return on this is actually 12 and a half. So if you try to recreate this, you would have to do 12 and a half to get basically what you're doing here to still happen within your 401k. Okay. So that's really like the strategy overall within this. And here's the neat thing. So you're going to continue doing this. And as you do this, you're going to have your loan paid off early. But these real estate deals, just to give you an illustration of how these work, they're typically going to be a $50K minimum. So you're going to put $50,000 into a deal minimum. And that $50K, let's make the math easy. That $50K, let's say it's going to do 12%, which equals $500 per month. Okay, so if I borrowed this $50K from my mech, and I'm paying that loan off early with that 500, which is basically the same thing as saving the 500. I'm just getting more interest on it by paying my loan off. If I'm putting that money back into my mech, what's happening is I'm paying my mech off early. Okay, so if I'm doing 500 a month, that's going to be 6,000 a year. Let's say that it's a 5-year deal. That's 30 grand in interest that I'm going to use to pay my mech back, which means that once my mech is paid back and the deal comes due, I've already paid off 30,000. So there's only another 20,000 I could put in there. And the reason that's important is at the end of the 5 years, I'm going to get my principal returned back to me. So if I paid off 30 of my 50 and I got 50 in principal that just came back, and I pay the other remainder of that mech principal off, which is the remaining 20,000, that means that I've got an additional 30K just sitting there in cash now. So when I reinvest, I'm not reinvesting with the 50, I'm reinvesting now with 80. So now the next deal I do, I've got 80, which is going to pay me $800 a month now. And the entire time, this 50 was growing, like we said, at a positive 2% spread, just like I never took it out. And that's important because we're inflation adjusting the income. If you did this with bigger numbers, let's pretend that the income was 5 grand a month and you're basically getting that appreciation on that 2%. And at that point where you come due on your principal, you reinvest all of it. Your 5 grand a month just turned into 8 grand a month. You're outpacing inflation by doing it this way. You're growing your income every single time you get more money than you took out, you can reinvest that money. You've got more money showing up at the end of every single term. And you've always got it available in your account, and the entire thing is still going to be tax deferred and tax sheltered. So that's really like the beauty of this plan, because when you're looking at a 401k, most people do invest their 401k based on the nest egg concept, meaning I'm going to get a big pile of money, I'm going to sell it off over time, and I'm going to hope that I don't run out. With this, guess what? You never touched your principal. The entire time, you never touched the 50K you put into it. So there's no chance you're going to run out of money. There's no chance that you're ever going to have to worry about that happening. Now, I know that we're watching and looking at all this, and it's like, all right, well, what is it going to take to set this up? Okay, this has got to be expensive. It's got to be complicated. It's got to be something that is very hard and a high barrier to entry on cost. Your setup cost on this, no matter what your account value, depending on what you want us to do, it's going to be anywhere from $3,000 to $5,000. Okay, to set the account up. $3,000 to $5,000. So $3,000 means that we're not going to whip the mule. We're just going to set the account up. We're going to get everything established correctly, and then you'll whip the mule to get the money to go there. Okay, now whipping the mule, this is going to be a play on words, is a pain in the ass. So we charge $2 grand if we're going to whip the mule. Now you might look at that and be like, man, 5,000, that's a lot. Well, what you don't know is when you put the money in your 401k, you paid 5.75% on what's called a front end load when you started it, and then you paid on average about 1.5% each year. And that's your annual management fee. Okay, and the reason you don't know about this is they don't bill you, they just take it out of your account. So you never physically pay an invoice for 5.75% of your funds. If you put in $100 a month, they took $5.75 off the top before that money ever went into your 401k. If you had, 10 grand in the account, they took out $1.50 each and every year, whether or not you made anything. They didn't bill you. You just had that money go there. Okay. So, and the reason that's important is if you look at over the life of the account, I want to show you what the fee difference is on this. So if you have a 401k, let's say you have, let's say $500 per month going into it. And that account grows at some point. Let's say it grows to 100,000 just for easy numbers. Okay. You finally grow that thing to 100,000. Your rate of return is supposed to be 8%. It's going to be in there for another 20 years. And you're paying a 1.5% annual management fee. So on that, just on this illustration we're talking about, if you had 100K in there for 20 years, and you're growing at 8% per year, and your annual management fee is this 1.5% that we talked about. Okay, what that means is that you paid over $130,000 in fees. Over that 20-year period, you paid $130,000 in fees. So that equals 130 grand that you paid in fees to have that account set up. All right, now our fee structure looks like this. So you've got this on this side, right? You've got 100K for 20 years. Our fee structure is, let's say it's the expensive one. You did 5 grand. You paid 5 grand for us to set this up for you. And our annual management fee is $500 per year flat. Okay, flat, meaning we don't charge a percent. We just have you pay an invoice each year for $500 and we run the whole account for you. So if you look at the numbers on this, you paid 130K here. You've got $500 a year going towards your annual management fee. So that's going to be 500 times 20 plus the $5,000 it took to set the account up. So that's going to be a whopping $15,000 over 20 years. So Jeremy, let me ask you a trick question. Would you pay 5 grand to save $130,000? Are you sure?
I'm thinking
It's a little pricey.
my best interest.
It's a little pricey. I know the math looks good, but I mean, man, this does look kind of attractive. So guys, that's the mindset you got to have. You have to stop thinking about, man, it's going to cost me to do this. It's going to cost you to not do it. And here's the deal. When you do this, you can actually reimburse yourself from the account balance, and you can write this off on your taxes as a qualified plan reimbursement setup fee. So when let's say you pay the 5 grand, you would write that 5 grand off on your taxes as a qualified plan setup reimbursement. Your annual management fee, same thing. The plan's going to cover that. You can write that off on your taxes as well. So you're actually saving quite a bit in taxes and in fees. And that's the difference in structure. Now, you can probably look at this too and realize why Wall Street doesn't sell this. So if you call Edward Jones like Lexi does and they say, hey, we've never heard of this account before. We deal with everything. We've never dealt with this. The reason why is Wall Street doesn't get paid enough money to mess around with this account. So they're not going to educate their financial advisors on how this thing works. A, because they don't make enough money. So they're not going to even talk about it. B, because most financial advisors are just uneducated and they do have a good conscience and they would see the difference and not want to sell the other stuff. So you've got to really look at like, all right, the fees make more sense. I've got more control. Everything lines up. This is a smart thing to do. All right. Now I do want to talk really quickly about account size. Like when is the right time to do this? Because this doesn't make sense for very, very small accounts. Okay, if you've got a tiny little 401k account, like let's say you had 10 grand. Well, if your setup fee is 5 grand, it probably doesn't make sense for you to do. And in my opinion, like if you're going to cash the account into a solo K and pay $5,000, you might as well just pull the money out of the 401k altogether. Just pay your taxes and penalties. Like 10 grand is no money. And this doesn't change the fact that we still do think a 401k is a mistake. Like, unless you have very specific circumstances, for the general population, we're not going to tell you to put money into a 401k, even if it's self-directed. The reason why is you are locking it up till you're 60. But this is a great way for you to salvage money that you already made the mistake with. It doesn't have to stay in Wall Street. It doesn't have to stay there getting killed by fees. And you don't have to pay your taxes and penalties. If you had $1 million in a 401k, you probably don't want to pull it out and pay your taxes and penalties. Like, you would be like, all right, well, I don't want to lose $500,000 in fees and penalties. I would rather just roll it over. So you already made the mistake of contributing to the 401k. This is a great way to salvage it and save the money from just being beat up by Wall Street for the next 30 years. But if you're just like, hey, I'm looking to contribute income somewhere, we're not going to tell you to take your gross income and put that into the 401k. That's a bad idea. So if you're in that position, that's what the sacred account is for instead. So that's really what this is going to look like. And as you're doing this, like, it is a very repetitive cycle. So it's a cycle where it's going to be easy for you to get distracted. It's going to be easy for you to look at what other people are doing. And you've got to know what the strategy is. The strategy is not for you to get a 26% rate of return in 1 year. The strategy is for you to get 8 to 12% every single year from your real estate deal, and for you to get 6 to 8% every single year from your life insurance deal, and for that to add up to about 10 to 15% year over year. And a couple of examples real quick that I want to give you of clients we've actually helped with. And I think I'm done with the PowerPoint if you just want to turn it into the camera. So we've had a couple clients that we've been able to work with where I'll just give you a few case studies. So we had one client that was with, I want to say like Wealthfront, one of those online shops. Wealth something, I think it's Wealthfront. And they had about 250K. And this money was in basically IRAs at this point. So they had some Roth, most of it wasn't Roth, and they had some traditional, most of it was traditional. Okay, so what we did is we took this client, we took the 250, and we set up the self-directed plan. We moved this money into it. And to kind of give you an idea of like what the process looks like, the self-directed plan, like to set that part up, that only took us like maybe a week and a half, you think, to actually establish the plan. That only took like a week and a half. But that client, their overall deal, what did that take? 3 months? Almost 4 months, I think. So we set the whole thing up in like a week or two. It took 4 months for us to finally tie everything together and close the deal with them. And the reason why is, like I said, that whipping the mule process. Okay, so we called these guys and we said, hey, our client's trying to move money. And they said, oh, we're just the advisors. We don't do the money moving part. You have to call our custodian. Okay, well, who's your custodian? Oh, it's these people. Good, how do we get a hold of them? Oh, they have just a website. If you check their website, you can call the 1-800 number. Cool, thanks, bro. We're glad we pay you 1.5% annual in fees for that. So we call the website, and they're very hard to get a hold of. I think no one pick up the first couple times?
Yeah, it took a little bit.
Yeah,
to pick up.
No one picked up. That's probably like the hotline. Like, they know that's where they lose money. So they're like, nobody answered that phone. Okay, so no one picked up the first couple of times. And then we finally got them on the phone. And again, like, we had the client on conference call, and these guys had no idea what we were talking about. We've never heard of that account. I'm not sure what you're talking about. There's no way you can be your own custodian. Who is the other company involved? There's got to be some other company we can send the money to. And we're like, guys, we just need you to cut a check, address it to this account, and mail it to us. We'll handle the rest. Well, we can't do that. You have to fill out the forms. Cool. Can you send it to us? Yeah. They send us the forms. We fill them out. And then we don't hear back. It's crickets for like a week. Finally get a hold of them. Oh, the forms. Yeah. You guys did them wrong. Okay. Well, can you send them back again? Yeah. And then we fill them in, put them back, send it back over to them, and crickets for like another week. And then they're like, oh, we lost the forms. We're like, how did you lose the forms? You told us this was the place to send them. We sent them to you. How did you lose the forms? And even if you lost them, it's like an email. Couldn't you just go to your email history and pull up the forms? You got to do them again. You got to do them again. And then we do them again. Oh, actually, you have the wrong forms. Sorry, you got to do the right forms. We gave you the wrong ones last time. I don't know how that happened. And in this process, these guys had our clients' money in stocks. Okay, who can remember earlier this year when the market corrected? So our client lost about 10 grand while they pulled this bullshit on him. Playing with his account, like doing all their preservation tactics. Meanwhile, he's just going down. Accounts dropping in value. That's what these guys are doing. Now, when we finally got that all straightened out, like we had to have several calls with them over and over and over. They finally transferred the funds, and it took about 4 months for it to happen. Okay, now our client on this deal, he's going to make, what is it, a little over 2 grand a month? 2,200 a month in cash flow. So this is going to equal about $2,200 per month in cash flow that he'll get. 2,200 a month, like just mailbox money. Every month it's going to deposit into his 401k account. Not only that, he's going to take that $2,200 per month and he's going to put that now into a sacred account inside the 401k still. And that's going to give him an additional 6 to 8% in dividends. And for all of this, we're charging $500 a year. Meanwhile, like they're charging him crazy amounts of fees, losing him money, doing all their account preservation tactics, all of that stuff, right? So that's one case study that we had. Another one, and this is one of my favorite ones I want to share with you guys. We did this with a client maybe 3 years ago, maybe 2 years ago now. So they had about $500,000 in assets in their old 401k. With this one, the husband actually got diagnosed with Alzheimer's at like the age of like 50. So he got diagnosed with early onset Alzheimer's. He basically had full disability from work. He could no longer work anymore. And so this was a circumstance where his plan was available for rollover early because he had to leave his employment. Now, what we did is we rolled this into, we initially met with the client. Their main concern was Medicaid. Medicare or Medicaid? Which one is subsidies? Medicare. Okay. Medicare, because he's got Alzheimer's, if he ended up in a nursing home, for Medicare to cover that, he has to be insolvent. And if he's not insolvent, Medicare will seize his assets to cover the cost of the care. So imagine like you did all the right stuff. You got $500,000 in your 401k. You get Alzheimer's. That's not your fault. But because of the way that the laws are written, if you want to go get care, you either have to go spend all of this money on a nursing home and pay. Lexi, what did Primrose charge people? Like 10 grand a month?
Easily.
Yeah, just stupid amounts of money, right? So he's got to either pay 10 grand a month just for that. He still has a wife. He still has adult children, like all of this stuff, right? So he's going to liquidate his entire account, option A, on spending it on a nursing home, or option B, hoping he doesn't have to go in one. But if he does, he'll go into a Medicare facility. They need to name those differently. They go into a Medicare facility where they're going to basically seize all of his assets so that he has, free care, but he had to give everything up. So what we did is this. We rolled it into a self-directed plan. So all of this money is now in a self-directed plan, and we loaned this money to an investor. Okay, the investor is paying him 12%, but guess what? He doesn't have $500,000 in his account. He loaned it all out. You can't collect money from somebody that doesn't have money. So if you went into a Medicare account or a Medicare facility, they would say, hey, we have to seize your assets. You'd be like, cool, well, I have $5,000 a month, but I don't have $500,000 anywhere. Now, the $5,000 a month, you guys are like, well, what about that? This was cool. So the $5,000 a month, because he's disabled, he can actually draw off his 401k without paying early penalties. So all he would do is pay income taxes. So if he's making the $5,000 a month, we took the $5 grand a month, we had him withdraw that from the 401k, and we had him put that into a sacred account that his wife owns. So he bought life insurance with the, let's say it's $3,500 a month that's left. So my boy here is broke. He has no money in his 401k. It's all loaned out. the $5,000 a month that he's making, he pulled all of it out and bought life insurance with it. So if he had to go into a Medicare facility, they'd look at his 401k and see zero balance. And then they'd look at, well, what about that money you're making? Oh, well, I spent it on life insurance. Life insurance is a unilateral contract, so they cannot touch that stuff. Could be his wife owns it. It's in his cash value. They can't collect on it. The IRS can't touch it. The government can't touch it. So we basically avoided this entire deal with a self-directed 401k. And I'm not going to lie, I felt like a freaking genius after I did this for them. Okay. And we had they met with another guy. This was a referral from another financial advisor. They came from a guy that could have sold them a thing. And he's like, I don't know what to do here, because he was just selling Wall Street products. Okay. This is the biggest referral I've ever gotten from a competitor. Okay. This is still a client of ours today. Okay. And the benefit here is with the Sacred account, it doesn't end there. The Sacred account, after about a year, they had $50K in the Sacred account. Guess what they did? They borrowed that out to do another deal where they made 8.5%. And they're going to pay their loan back with the Sacred account. And eventually all of this money that we see in the 401k is going to get funneled into the Sacred account. And at that point, they won't have any more money left in the 401k. He'll be fine. There's no liability there. So that's what we did with this client. Now, the best part about this deal, I'm going to elaborate a little more just so you can see how cool these strategies are. So this 8.5%, this was a 9-month term. So she's getting 8.5% on a 9-month term. And at 9 months, they're supposed to give her the $50K back. That's how the term works, right? So 9 months come around, you're supposed to get the $50K back. Principal comes back. You could reinvest if you want to. You go to do a different deal if you want to. So on this deal, 9 months came around and they didn't have the ability to return her capital. They said, hey, we're tied up. We don't have the $50K liquid. We can't get it back to you. And most people, if they did a deal like that and it didn't pan out, they'd panic. If you did $50K in the stock market and they're like, oh, you gave us $50K, we can't give it to you. You'd be like, I'm broke. Well, this is different. She's secured by real estate. So she has two options. We put it in the contract. A, she can foreclose. B, she can charge them 18% interest instead. So she opted to just stick a 1 in front of the 8. And they'll pay her 18 until they can return her funds back. Ultimately, if they can't, she can foreclose and just get the real estate, and now she's the owner. And the real estate is worth more than she put into it. They would not have borrowed money if it wasn't worth more than they were getting the money for. So either way, she wins. But imagine that. Imagine being in a position where you think you're going to lose everything because of one slight change in how we did this. We helped this client become their own bank. They were able to do all of this. Even the worst case scenario happened, and they're more profitable than they would have been even in a best case scenario. Guys, that's how you become your own bank. You guys have heard the phrase that the house always wins. I know that applies to casinos, but it also applies to banks. And if you can become the bank, you can control. This is the thing, you can control. This client was in 100% control of everything. This note, she's in control of the paper. That's why she's able to do that. She's not hoping for returns. She wrote into a contract, this is what will happen in this circumstance and this circumstance and that circumstance. We can't return my capital. I'm going to do this to you, or I'm going to take your thing away. So that's really the banking concept. It's not just about investing and trying to get big returns. It's an actual philosophy of having control over your finances. When you invest with Wall Street, you're not in control. There's not a single Wall Street deal you can show me that's that badass. There's nothing out there like that. The only way you can do that is, like Jeremy said, you have to be creative, and you can't be creative if you're not in control. Okay, so real quick, I want to open it up for questions if we have any. I know we covered a lot tonight. So if we have any in the comments, but also if we have any in the room, I'm happy to answer those as well.
Could you do something like this with self-directed?
With a self-directed IRA, almost. The IRAs are not allowed to own life insurance. So you can do note deals, but you can't do the arbitrage. With a self-directed IRA, you can convert it to a 401k as long as it's not native Roth money. But it could have been if it is Roth money, let's say it came from an old plan, that's doable. But it can't be contributed from income as Roth.
Like I rolled a 401k into a self-directed traditional.
Okay. So then you could convert it to a self-directed 401k.
So I
Yeah. And then you can basically set it up like that. Yeah. Any other questions?
No questions.
Awesome. Well, thank you guys for watching. If you watched this tonight and it blew your mind, make sure you go to sacredaccounts.com. I'm going to go ahead and write it up on the board for you. That's going to be www.sacredaccounts.com. Okay. Make sure you check that out. If you watched this tonight and it confused you, you were already confused. You just realized it tonight. Go to sacredaccount.com still. If you'd like to reach out to us, you always can. But we want to thank you for watching. And if this was valuable to you in any way tonight, I want to have you like, share, and subscribe to the video. We have this on Instagram, Facebook, YouTube. We'll also send this out to you guys on email later on this week. Have a great Friday. We'll talk to you guys next time.